Imagine you own a house worth $500K. You're thinking about selling it, but you're not quite ready to do it yet. At the same time, you're worried that if you wait too long, the housing market may fall and the house could be worth much less. So you pay $5,000 for the right to sell this house for $500,000 at any point during the next 6 months. This agreement works a lot like put option. A put option gives you the right, but not the obligation, to sell the asset at a fixed price before a specific deadline. The $500,000 sale price is the strike price, the $5,000 is called the premium, and the 6 months deadline is the expiration date. Now, imagine that 3 months later, housing market crashed, and similar houses are worth only $400K. Your agreement still allows you to sell your house for $500,000. That right became very, very valuable. You can sell something worth $400K in the market for the previously agreed price of $500. But suppose the housing market goes up instead, and the house is now worth $600,000. You would not use your agreement to sell it at $500,000. You would simply sell it at the market price of $600K. In that case, the put option may expire worthless, and you just lose the $5,000 premium. A put option on the stock works in exactly the same way. You pay a premium for the right, but not the obligation to sell the shares at a fixed strike price before the option expires. If the stock falls far enough, the put option becomes valuable, and if the stock stays above the strike price, the option simply may expire worthless. The buyer's maximum loss is the premium paid. But the price must move far enough and before the deadline. The easiest way to remember is that a put option is like a paid insurance that gives you the right, but not the obligation, to sell an asset later at a price agreed upon today. Thank you for watching. Click like and subscribe, and see you next time.